The next option is a 0% credit card. What about people who don't own a house? In these cases, many turn to 0% credit cards to reduce debt. Again, prudence and discipline are required. Companies offer these rates as teasers, enticements for you to switch credit card vendors. Much of the time, card companies target consumers with better credit, so that may leave someone struggling with debt without this option. Even if you do qualify for a 0% or similar single-digit rate, it won't last forever. Make sure you know when it will end and at what rate it is expected to jump to when it does. The low rate also lasts only if you pay on time. One late payment and the credit card company will jack up the rate. Also, look for the hidden fees and charges that can increase the actual cost of credit. It's a short-term fix, says Vile. The only way it works is if you are really meticulous about paying it and staying on top of it, and then move on to another credit card before the lower interest rate expires. Opening new credit card accounts every 6 months, however, could negatively affect your credit rating, he cautions. And to successfully lower your debt load, you'll need to pay off far more than the smallest amount the card company will accept, especially after the zero rate disappears. Paying the minimum for a $20,000 debt won't cut it, says Vile. Payment calculators illustrate this. For example, you transferred $20,000 of other debt to a 0% card and paid $1,000 on it by the time the rate jumped to 14%. If you make only the minimum monthly payments, it will take you 1,134 months or 94.5 years to erase your remaining $19,000 balance. If you live that long, you'll pay $64,805 in interest. And that's presuming you don't charge another thing during that time. Did the credit card computation scare you off into looking for another option? There's always a debt consolidation loan. Offers for these financial products are an email box staple. Chances are you get a dozen or more every day suggesting that this is a solution to your growing debt problem. A major appeal of consolidation loans is convenience. Instead of paying 20 different creditors who are charging different rates at different times of the month, you take out one big loan to pay off all those accounts. Then you make a single payment on that loan once a month. But ease doesn't automatically translate to savings. Before you sign on the dotted line, be sure that the cost of the new bundled loan will truly be less than what you're already paying various creditors. For many consolidation loan candidates, their current credit woes won't mean they get the lowest available interest rate. Plus, when there's nothing to secure the loan, such as your home, expect the lender to bump up that rate. Calculate interest and fees on all your existing accounts to determine the total of the payments you now make. Then compare those amounts with the consolidation loan numbers to make sure it's truly a better choice. And as with any product, shop around. The bank down the street may offer an attractive loan rate, but a check of your local credit union could turn up better terms, says Deborah Noddington, author of The Get Out of Debt Kit. Credit unions also tend to be more lenient than the banks, adds Noddington. Your next option is managing, not adding to your debt. Vile is a much bigger fan of debt management, which isn't a surprise since he heads up a debt management firm. But Noddington and other experts also point to credit counseling instead of shifting debt as the way to go. They favor debt management because it costs less and is quicker than a debt consolidation loan. Vile says someone owing $20,000 would end up paying $6,000 to $8,000 in interest and fees and be debt-free in 4 to 6 years by using a credit counselor. If that person took out a 15-year home equity loan at 10% because his credit wasn't good enough to get him a lower rate, our calculator shows he'd end up paying $18,686 in interest on top of the $20,000 he borrowed. But if you just can't get a handle on your bills by yourself, you should explore credit counseling. Getting professional help in managing your debt can help you change your credit behavior. People that have taken on too much debt tend to go into denial. They'd rather not know how much debt they owe. A professional debt manager will make you face up to your obligations. Credit counseling agencies also force you to stop racking up debt. In exchange for consolidating your debt and working with your creditors to reduce your payments, credit counselors require you to give up your credit cards. Credit counseling, however, is not without its costs. One downside is that your reduced payment plan will probably show up as a mark against you on your credit report. Even though your creditor agreed to reduce the payment, you technically did not pay your account as called in for in the original credit agreement. An even more costly potential pitfall is the disreputable debt counselor. As a recent Bankrate story points out, some credit counseling and debt consolidation companies are only interested in making a quick buck on debt-ridden consumers. Some firms offer shoddy service and sky-high fees. Others are out-and-out scams. To find a reputable firm, verify certifications or third-party registrations. Check with the Association of Independent Consumer Credit Counseling Agencies or the National Foundation for Credit Counseling to see if the service you're considering is a member of either group. Also, ask the service for references and then confirm them. Make sure that the debt management or credit counseling firm answers all your questions and that you have a firm understanding of how the process will work and what it will cost. If the company won't give you straight answers or you don't understand what's going on, don't sign up with that company.